Okay, now this next one, this is going to be a 5 ticker event. It's kind of Tim Melvin's version of Dogs of the Dow. Right? If you
Dogs of
remember,
the Dow. Okay.
if you remember that one, that was you bought the 5 highest yielding stocks in the Dow Jones Industrial Average. You rebalanced every year, and actually you beat the market, and it went way out of favor. Everybody forgot about it, so naturally it's worked the last couple of years. Um, but as you play around with this, simple one decision, 1 year stock decisions, right? So you want to just build a portfolio of a handful of stocks so you don't have to be watching the whole world that can deliver market beating performance and it is easily implemented. So this is so ridiculously simple. We're going to limit our universe to the S&P 500. That's it.
Okay.
That's the only universe we're looking at. We are going to throw out all the unprofitable companies. All right, because
Okay.
unprofitable companies and bad credit, why deal with them if we don't have to? Guess what? We don't have to. So only profitable companies. Now we are going to pick the lower priced companies, the 5 lowest priced profitable companies in the S&P 500. We are going to hold them for a 1 year, and then we are going to be done with them. And this beats the market rather handily. Over the last 10 years, when you would think that just running with the index fund would be the thing to do,
Yeah.
you've done pretty well, about 12.5% from today going back a decade. If you just use this simple system, it's 15.5%. It's ridiculously easy to implement. You buy the stocks, you hold them for a year, and then you come back come back next year and you do it again. Um, you do not outperform each and every single year. There's only a few instances where you badly underperform, but just sticking with this system, you actually do a lot better than the S&P 500 over time. Now, I know y'all are waiting. Come on, Tim. Give us the stocks. Stop with the damn story. We don't really care that much, right? We want to know what the 5 stocks are. So I got the 5 stocks. All right. And this is, by the way, today is a ticker fest. I should have warned you. I hope you have
I'm
your
taking notes, and I've got 5 in the chat already, so we're good.
okay. So here we go. Ready? Amcor, AMCR. This is a Swiss based packaging company. They do business all over the world. The company is profitable. Um, Actually, going to see a nice bump in earnings if the analysts aren't complete morons. And, usually they're not right, but they're not complete morons either. So we should get a pretty good bump in earnings over this year. Next 5 years looks pretty good. And of course, anything that grows earnings globally a little bit, i.e., getting all this tariff madness behind us sometime
Mhm.
over the next 6 to 12 months, then this is going to be great. Now, the cool thing here, they pay a 5.59% dividend. So lots to love here. Great earnings growth, nice dividend. It's a non-US stock. And if you've been playing along at home, you know that I'm quite bullish on European stocks. And
Mhm.
Switzerland, I just absolutely love Swiss stocks when you can get them at the right price because Switzerland just sits there in its little corner and says, "Oh, hi, Globe. Yeah, no, we don't care about you." And they do whatever they want to do to keep their industries profitable. They're relentlessly and ruthlessly capitalist, but they support business and commerce, and they just sort of ignore the rest of the world. And it's like, okay, here's our rules. You can play by them, or just don't come here. And I like that a lot.
Let me ask you a really quick follow-up question here from Brandy. Brandy was saying, Ryan, on your Apple chart, that was the one I had set with the RSI set to 5. It was a day chart with the RSI set to 5. Would this same setup work for day trading on a 5 or a 15-minute chart? I know that you're more of a long-term guy here, Tim, so this probably made your skin crawl a little bit, maybe a little
No,
throw up in your mouth. But the whole thing here, I'm just wondering if we can kind of adapt the what we're talking about here for maybe some shorter term time frames. Is that possible? Do you have data on that?
I do not have the data. I would suspect so, but
Okay.
to quote that same old famous trader, if it can be tested, it must be tested. So
Okay.
if you've got the idea and you've got the data, start crunching and
Okay.
let's see if it works. I suspect it will.
So Brandy, so then This is a great question. We don't know the answer, so maybe then let's watch that and let's see if we can find any patterns that were as clear as they were on the day chart. And then maybe we can also not only adapt, but also kind of tinker with some of these. Maybe there's a setting or perhaps another indicator that we can add that gives us a more clear signal. Good stuff there, though. I like the thought process. I like where you're going there. Okay, Tim, I'm sorry, I didn't mean to sidetrack you there.
That's okay. AMCR is our first one.
Yep.
The next one is Ford. Uh, Ford is F. Ford is the best of the U.S. auto manufacturers, which unfortunately in recent years has been like being the best team in the American League Central Division. I mean, it's kind of cool, but it doesn't mean all that much. But Ford is they're building great cars. They build fantastic trucks. They build the best trucks in the world, as far as I'm concerned. They're way ahead on EVs of their U.S. competitors. And I always love Ford because during the great financial crisis, Ford did not do a strategic default on their bonds, and GM did. So I'm kind of a Ford fan. It's also a great stock to do combination option trades are when the world is blowing up. But it also makes this particular screen, and it's profitable. They're going to be profitable this year. They should grow at an okay rate over the next several years. Nothing fantastic. It is a multi-billion-dollar company, but you're getting a dividend of over 6% with this stock while you're waiting over the next year. So, and we do not intentionally screen for dividends, but the screen does tend to produce dividend payers because they are large cap stocks in the S&P 500, and profitable companies in the S&P 500 tend to pay dividends. Next up is AES. And it's power generation. And again, it's profitable. They should have a nice year this year. It's trading at about 5.6 times earnings. It's got some long-lived electrical generation assets, yielding again about a 6.8% dividend. They've got a U.S. business. They're active in South America. They're in the Caribbean. They're in Mexico. So they're kind of doing business all over the world. They've got some operations in Europe and Asia. Company's been around since 1981. It's gone in and out of the headlines for various energy-related controversies over the years. But it is a great company that is going to benefit dramatically from increased energy demand over the next couple of decades. So the stock is sitting here trading at a ridiculous valuation multiple, paying a very generous dividend, and you're just looking to buy this here and hold it for a year. If it's still one of the lowest priced profitable companies next year, you keep it. If it's not, you sell it and you move on. So that's AES. Then there's IVZ. This is Invesco. It's investment management. Let's just pull this one up. And again, nice dividend, 5.79%. Okay earnings this year. Single-digit growth going forward. Not, the world's most exciting company. They do mutual funds, unit trust, exchange-traded funds, closed-end funds. Been around since 1935 down in Atlanta. So I guess these guys are all Braves fans, but we won't hold it against them. So they,
we got a couple. I think we got a couple of Braves fans in here, so be careful.
Yeah, well, as we talked about, I can't get the Orioles on local TV down here. In spite of that, they're blacked out because you could shoot a ballistic missile from here to Baltimore. So apparently that means we're blacked out. No bitterness there. So I have been watching a lot of the Braves games because they're kind of the local team here, and they're actually a very good baseball team this year. And then finally is Host Hotels and Resorts, which is HST. Hotels are ridiculously out of favor. This has really high levels of insider ownership, one of the highest in the entire REIT industry. When you have to go all the way into the proxy to find the insider ownership on this one. But again, 5.5% dividend. profits will not be going up, but they will not be losing money. It's going to be very flatline over the next several years. The big story here is this is probably at a between a 30 and 40% discount to what the buildings could be sold for in a more rational market. It's mostly luxury and upper scale hotels. They've been around a while. They've been around since 1927, so they've been through some problems, more than one crisis. So just a hotel REIT with a high survivability factor, a really decent dividend. And again, when all the madness is over and we start to get to the other side, luxury travel picks back up again. Good things begin to happen for host hotels and resorts. And again, this is totally quantitative. Although I just told you the story of what they all do, we don't really care, right? It's low priced, it's profitable, it's in the S&P 500. We're going to buy it, we're going to hold it for a year because history and math tell us that is a successful investment strategy.
Okay.
Okay, now the next one is the most exciting one. So get your pens and pencils out from here because we're gonna go through some stuff here. A study just came out, and let me just pull this bad guy up here so I can tell you who wrote it. One of the professors was from Auburn, one is from Florida State, and the other one is from the University of Tulsa, which, believe it or not, actually is a very robust business department. So these three got together and they looked at REITs and they looked at factor-based REIT investing. Now, factors are things, they're PE ratios, they're EV to EBIT, they're mathematical quantitative formulas that help you identify um, uh, conditions, factors that are relevant to stock performance, like price to book value has been very indicative of high performance, so has momentum. REITs are not necessarily responsive to the same factors that stocks are for a whole bunch of reasons. So what I've done, we don't have time to walk through today, Ryan, all of the different ways the factors are different. So if you're truly interested, I sent Ryan the study, email him, he will send you the link to the study.
He did. He did. Wait, do you want me to just throw this in the chat now?
Sure, why not? I mean, this is a great study. It's you hate to use the word groundbreaking, but it's a little bit groundbreaking. So
here's the deal, Tim. I got several appointments today, and if I've got a bunch of people emailing me, I might not get back to them. So I'm just going to drop it in the chat.
No, just drop it in the chat. That works just fine. And if you're interested, go ahead and read it. It's not as dense as some other studies I've read, so you could figure out how to reverse engineer this. I won't tell you that it's easy, but I will tell you that it can be done. So, but here's the 6 factors. I'm going to give you 6 factors and a couple of stocks. Okay.
Perfect.
All right. So going in, they found that size actually is very predictive of higher returns among REITs. Smaller REITs over time actually tend to outperform the broader market by just a little bit. This was the weakest of the 6 factors. Okay.
So the size of the REIT is predictive of its future results?
Yes, smaller. Well, it's just like small cap stocks. Small cap REITs. And there's a couple reasons for this. They've got a runway for growth through acquisitions, and M&A does play a role anytime you're talking about small caps. It is notably less pronounced in REITs than it is in general equities, but it does give you a small edge. So here's your smaller REITs that would qualify using their formula.
And really quickly before you get into this, Quantum asking a pretty decent question. Is this even with higher rates? So this is an okay strategy even when rates are high. Okay, sweet. Good question, Quantum.
Absolutely. And by the way, REITs in periods of rising rates have done shockingly well. It's a great study on the NAREIT site. And I'll get that for next week, right? I'll have that study and we can go through it. Okay. So small REITs, here we go. Alexander and Baldwin. This used to be a shipping company primarily.
What was the ticker? Sorry.
Alexander and Baldwin, ALEX.
ALEX, got it. Okay.
Right. They're 19th century sugar plantation company. They've successfully transformed now into a REIT. It's real estate land operations with a material and constructions business, almost entirely based in Hawaii. Hawaii, of course, being probably the most land constrained state in the U.S. So Alexander and Baldwin, really good small cap REIT to take a look at. Plymouth Industrial, I, if I would date Plymouth if we were both high school students. Plymouth Industrial is one of my absolute favorite REITs. They do single and multi-tenant industrial properties, but they do a lot of single family industrial properties, which tend to be corporate headquarters and main shipping points located in industrial parks. They're in markets across the United States. They've been really smart about their M&A and growth strategy. So PLYM.
Mm-hmm.
And then there's the most controversial pick.
Really quickly, you wanted to date industrial REITs in high school, and I was busy trying to go after volleyball players.
Well, I mean,
so now I see what I did wrong.
No, if Plymouth Industrial was a high school, the high school, she'd have been the cutest high school girl that everybody wanted to date. It's a great REIT, was my point.
Okay.
Got it. All right. So look, not all the puns and jokes are going to hit, guys. I mean,
no, we're gonna keep you on your toes. That's what we do around here.
Okay. All right. I'm going to start being like Switzerland. I don't care if you like the jokes. We'll just move on.
That is actually a pretty good tie back, to be honest with you.
Yeah, and now, the most controversial one in Postal Realty Trust. They own over 1,000 properties that are post offices. They're leased to the United States Postal Service all over the United States. There's dire predictions on the future of the post office, but there's been dire predictions on the future of the post office. I don't know, since I was in Knickers, basically. The company's portfolio is all post office buildings, mail processing facilities, garages. They're under super long-term leases. You don't see the post office close too many locations. When they do, their buildings are usually easily saleable in the market. So there are accelerators in the lease. So it's kind of interesting, but governments and government agencies are in a state of flux right now. And I do think that, as we go on, the internet has already disrupted the postal business, as has FedEx and UPS. I'm kind of interested to see what API does to the postal business. I mean, AI does. So, but anyway, PSTL, in the meantime, it's a pretty cool REIT. Whitestone REIT is another REIT I've really liked for a long time. They do community center retail properties in neighborhoods and major metropolitan markets. They're looking for high income, high population density, and you're looking for internet proof businesses, grocery stores, restaurants, cafes, doctors, gyms, things you can't do on the internet, and really kind of community center and integrated shopping centers. It's a really good, well-managed REIT. Then Investors Real Estate Trust. This is apartment communities. I could do an hour on why apartments are a great buy. Let's just say, as long as mortgage rates are up and there's a housing affordability crisis.
Sorry, what was the ticker on that one? I couldn't get that one.
WSR, or the Investors Real Estate is
Investors Real Estate.
IRET.
IRET. God, that's a REIT anagram right there.
Yeah. Yeah. So
IRET. Okay.
I just want to make sure we've got that one correct. Okay.
This Title Trust to IRET.
No, that's the EAT index, guys. It's IRT. Sorry about that. My handwriting got me that time. So IRT is what we're talking about. Multifamily is going to be strong as long as there's a housing affordability problem. And, long story short, you've got a whole bunch of people in the nicer apartments that should have moved out and bought a house by now. Instead, they're still in the apartments, which means we've got demand backing up, and nobody's been financing apartments for the last 2 years. So deliveries now are going to slow dramatically in the second half. And everything that was delivered last year and this year that was supposed to be empty, it filled right up, because you've got this log jam of renters in the upper end buildings, the Class A buildings. So then the value factor in REITs is actually pretty high, especially when you take out negative momentum and you add in quality. One of the higher performing ones is value. Now they calculate value differently, just like you have to use funds from operations instead of PE ratio. You need to read the study to make sure that you're actually adjusting the value factor, but it's one of the top performing factors. And quickly here, Macerich, premier shopping centers in the United States. These guys went through a bankruptcy, got rid of all their garbage centers, and they had a lot of them that were pretty much plowed under.
That's
Um,
MAC.
yeah, MAC. Now
This
they're
was
in
a
like
$100 stock at one point, wasn't it? Yeah, it
yeah,
was.
yeah, yeah. Now, and there's been a lot of reverse splits and stuff here, so that
Okay.
kinks it out a little bit. But they were in like really today. They're in densely populated, wealthy markets in California, Arizona, and primarily the Western states. They've been really aggressive about repositioning their property portfolio
Mhm.
because the standalone Class B or Class C mall is truly dead. Okay. I mean, even malls that you thought would never go empty are empty. It's the malls that have the movie theaters, the bowling alleys. The one here in town has a bowling alley and a movie theater, and it's doing okay. But it's got the Apple stores, it's got the upper end stores. Those malls are good, and
Yep.
Masterich is slowly but turning, going that way. And CBL and Associates is the same thing. It's regional malls, open air centers, mixed use properties in southeastern or midwestern United States. They are also, they reorganized, they're reducing the debt, they're doing strategic property dispositions, but it's cheap on the numbers. So, Seritage Growth Properties is they're trying to unlock the real estate value of former Sears and Kmart locations. And again, it's kind of a story in progress. If you've not seen a theme here, there's a ton of retail property, retail REITs in here. And then Tanger Factory Outlets. I love this one because it's so ridiculously misunderstood. These are factory outlet malls.
What's the ticker?
SKT.
Okay, that was it. Okay.
Okay, now in good times, people like a bargain. In bad times, people need a bargain. That's a direct quote from the founder of Tanger. Um, These are the outlet malls, the premier outlet malls that people take buses to. I used to live near a Tanger Center, and people literally took bus trips from surrounding areas to come here and spend the day shopping at these
Mhm.
malls. If you notice them, they're usually right around freeway exits. When you drive down the road, you look over, the parking lots are always full. And they were full. If the work, the minute you could open back up in COVID, boom, they were full.
Yep.
In 2008, 2009, they did not have occupancy problems. These are great properties to own. So Tanger is the other one that is definitely looking a little undervalued there. And the momentum factor is one of the very strongest factors in REITs. Trends in motion tend to stay in motion. Post 1990, momentum's really been the dominant factor, been really resilient during market downturns and higher interest rate periods, to go to the easier comment. And here, I mean, these are pretty easy to pick out. Digital Realty, which is data centers, co-location centers.
Hmm. Hmm.
Prologis, which is warehouses and logistic properties all over the world, and they're starting to get into data centers. American Tower, this is owners and operators of cell towers all over the world, U.S., Asia, Latin America. Great business, going to continue to be a great business. Public storage, and then believe it or not, Avalon Bay Communities, which is luxury apartments in high barrier to entries. These are the downtown office towers for the most part. The really high quality, high class A properties around the country. Then quality, another pretty easy one. This is just the very best REITs with
Ticker?
uh, I'm sorry, Avalon Bay's AVB.
AVB.
Right. So quality is another very consistent factor. And here you're just looking for the best REITs with steady, consistent ROE, dividend growth, all of those fun things. So the grandpa of quality REITs is Realty Income. They've now made 641, the symbol zero, O. Um, they pay monthly dividends. They've made 641 consecutive monthly dividends and have increased the dividend for 29 years in a row. They are a net lease REIT, which means that the tenant pays taxes, insurance, and maintenance. So they just collect the rent on the property. It's a pretty cool business. Obviously, high margins. They've got over 11,000 commercial properties, primarily in the United States, but there's some in the UK and Spain. It's 1,200 commercial tenants, and the tenants are exactly who you think they are, right? Starbucks, Walgreens, CVS, Whole Foods, Publix, HEB, 7-Eleven, restaurants, standalone buildings all over the United States. If you pull up to a stoplight and you look to your right, you look to your left, you look across the street, there's a good chance that Realty Income or one of their competitors owns the building.
Okay.
And then Crown Castle is also another cell tower REIT with 80,000 miles of fiber supporting fiber broadband all across the country as well as small cells. So again, communications infrastructure, AI, 5G, a bunch of things play a role in this. CCI, extremely high quality. Then Equity Residential, this is Sam Zelzo property. Crown Castle CCI, by the way. EQR is the largest publicly traded apartment REIT in the United States. Again, if you're driving through a downtown and you see tower apartment buildings, you see really nice apartments within striking distance of the highway. If Equity Residential doesn't own them, Avalon Bay probably does, particularly in the Northeast and the Chicago area, being as that's where Zell is from. So just, they're in the markets, high barriers to entry, like downtown Chicago. Really hard to build a new multi-story apartment building there. They look for strong employment growth, high-paying industries, favorable supply-demand dynamics. Reading their corporate company presentation, by the way, it's probably worth a college credit towards your MBA in multifamily real estate. It's really good. And then Simon Property Group is one of the largest retail property owners in the world. They have premier shopping centers, they have outlets, they have the lifestyle kind of centers, which are the outdoor shopping centers that have the gyms and the movie theaters. And you know exactly the ones I'm talking about, all across the United States. They have the very best tenants in the very best properties. They're the high end of the Class A mall market. They've never missed a beat. They've continued to pay and raise the dividend. They have pricing power, which something most retail REITs don't have. They're able to raise their rates. Tenants are standing in line to get into their properties. So SPG is a very, very good, high quality selection. Then I want to move along here because I don't want to take all your time.
Well, yeah. How much more do you have? Because this is a ton already, and I got questions I got to ask you, and we're already kind of over.
Right. We'll save the last two factors for next week. We're over. Fire away on the questions.
All right, let's do that. Here's the complete list. You guys are asking for complete lists. Between me and the producer, we should have them all in there. I'm going to start with this one. CCI just cut the dividend. Is this a concerning indicator?
No, not yet. If it continues, it would be. REITs cutting dividends in here in response to higher interest rates, not entirely shocking.
Okay. Next one here. Jay Rice. Good morning, Jay. Those tower names scare me. I think down the road, satellites are going to replace them, like ASTS. This is more of a comment than a question. I was just wondering if you have anything on that.
Jay, you're probably right, but it's a long road. And also, the other thing is we can't, for a whole bunch of national security and homeland defense, we actually cannot go to a totally satellite-based system because you could take out our satellites a lot quicker than you take out all our towers.
Another comment here that I agree with. People want entertainment options at malls, not more boring clothing stores. Exactly, Quantum. That's part of my big problem. I'm with you on that.
That's why you want Simon.
That's right. Here you go. Caddyshack. Any GMRE update? This is that global medical REIT. Full disclosure, I still own this. I've added to this as it's come back in. This pays a great dividend.
I can't find anything in the statements, the comments, by the financial statements, where I mean the comments and commentary to fully explain the price decline. They're not growing. They're not making a whole bunch of acquisitions. They're not expanding. That's intentional. I think it's smart. I think the dividend is still okay for now. It's a price location, and I think it's a buying opportunity.
Okay. And then Tracy here, an odd question, but one we should definitely ask. Can you tell me anything about Morehead City? I have a job offer there, and I'm from South Dakota. I'm not sure about moving that far unless it's awesome.
Morehead City, only by reputation, is supposed to be awesome. I mean, never spent a lot of time there, so I don't know it. I can tell you that we like the state of North Carolina a whole bunch so far. It's been awesome. But keep in mind, we did just move here.
Okay. Keep updating. Thank you, Tim. Really good stuff here today. Tons of tickers. I'm sorry to cut you.
No, no,
but
you.
we'll
I
be back
didn't
next
realize
week.
we'd run over. We'll come over. We'll do the last two factors along with some more REIT stuff next week because I think it's a good topic for this market.